The Redbox stock has been the topic of many conversations as of late, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying more stocks. As the market is very volatile at the moment, we should be mindful about which stocks to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. In recent trading sessions, Redbox confirmed that it would have a pullback or at least a pause in the price action after weeks, if not months, of a spectacular rise. As we previously mentioned, this is probably not due to the existing short positions weighing in, but rather because the shareholders were eager to realize their capital gains after seeing those increases, and the more it increases, the more the retail shareholders would be looking to cash in quick profits, at a cost of potentially slowing down the bigger price trends. Of course, let's remember that what differs the current short squeeze attempt from the previous ones is the vastly different environment in which the whole phenomenon happens. Even if the stock-specific events, like a short squeeze, are by definition unique on by themselves, we must keep in mind that the individual stock prices are usually influenced somewhat by the larger environments. Redbox, from a fundamental perspective, will offer little to no impact to its price actions, as its business model seems to be at odds with what the consumers are mostly looking for. This is why, in my opinion, I think that the reason why most people are buying Redbox shares is because they believe that the short squeeze is going to succeed. I think that ultimately the shares would be continuing increasing as long as the short positions have not been redeemed. Now, let's also take a look at the technicals of the stock. The trading volume of Redbox has recently been 10 million shares versus an average volume of 27 million shares. Over the previous 52-week period, its price fluctuated between $1.61 and $27.22. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you an idea about the popularity and the trend of the company. When we use it to compare against the average volume, it can also provide us the information about if the company is having additional momentum to reverse an existing trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal may happen soon. The market cap for Redbox is currently around $528 million versus an enterprise value of $297 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost that the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be the intangibles, meaning they're not items or equipments or inventory that a company can use, but promises that this company can grow significantly in the future, such as pledges for major contracts, blueprints, and new products. For startups, most of their valuations are based on these intangibles, which could have been valued under more favorable market conditions, and in concrete terms, what this means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below its book value, and it doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself has been overvalued to begin with, and it has been deflating back, something approaching the reality ever since. As we compare the current price to the historical price fluctuations, the stock is 110% higher than the 1-month low, 455% higher than its 3-month low, and 538% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 220% versus a historical volatility of around 310%. The put-call volume ratio is currently at 0.84, and it's normal for many stocks to also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 65,000 contracts a day versus the 30-day average of 79,000. In terms of open interest, the most recent volume of open interest has been 218,000 contracts versus the 30-day average of 196,000 contracts. Put simply, the option contract is a derivative from the underlying security, which gives the participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums, with an obligation to execute the contract if the counterparty chooses to exercise them. It's often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, then there may be possible uptrends on the move, or that a reversal can happen if there's a lot of call options. The reasoning behind that theory is quite simple, as most option contracts always expire worthless. In terms of its shareholder structure, institutional shareholders own about 291% of all outstanding shares. This doesn't mean that shareholders somehow own 3 times what the current float is, it just means that there's a significant amount of short interest present. It is relevant to understand the shareholder composition of a company because that can help us to determine whether you should hold the stock long-term or not. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. With that being said, let's also remind ourselves that it's not because something like 291% of institutional ownership is present that it's necessarily good news. It just means that those who own the shares are probably shorting it. Typically, the consensus is that there should be at least 25 to 30% of institutional participation long in the stock for the stock to be perceived as a sound investment. Of course, a lot of exceptions would apply since many great titles are also held by retail traders and they can do still pretty good. But so far, that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there's significant short interest in the total volume, this may be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 104% of the total float, with 53% of them happening from the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it happening outside of the public exchanges, this may suggest that there are institutional positions taken to short the stock and that there would be potentials for a short squeeze. My recommendation on Redbox is to buy the stock now and to put in a significant portion of the allocated amount whilst keeping in mind that the price action in the immediate term may not be as straightforward as one would hope. The stock is going through a relatively large period of volatilities, and this event is time sensitive. Overall, I would recommend to commit between 1 to 3% of your portfolio's capital in Redbox and to split the allocation in batches of 30% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.